Solita, if I can start with you, the tech leadership, the AI leadership of this market, is it broken or bent at this point?
Not broken. Maybe let me start with, so coming into this year, we have been advising our clients that we're bullish on artificial intelligence, but we should expect volatility. And of course, we were 2 years into this rally. You have, uncertainty around the political environment, and of course, we got that volatility, right? And probably will continue to be here for a little while. But our views actually has not changed. We are still bullish on the broader AI theme. And technology, in fact, is our favorite sector, and US in particular is our most preferred region in our portfolios. And there are a couple reasons for that, right? And one is, I think the DeepSeek news is a positive overall for the AI story because lower costs lead to wider adoption. And that's pretty much has been the tech playbook throughout history. When we look at cloud, for example, Amazon sales went from 5 billion to 100 billion over the last decade, despite prices falling significantly. And also, I think this big spending on AI from the big players is not stopping anytime soon. In fact, we have revised up our capex expectations from the big four, not down. And structurally, I think the US AI leaders are very well positioned going forward. They're still delivering robust earnings growth. And structurally, they're operating across the AI stack. They're sitting on piles of cash. They have mountains of data. From month to month, it's hard to predict who's going to be leading the market. Right? Even within Magnificent Seven, there are some names we like, other names we don't like as much. But I would say, these companies have, are really well positioned. Now, one thing I would say is, all of that said, it's not US tech, and it's not the only game in town, right? We like other things. We like industrials we like healthcare and financials in the US. There are things we like in Europe and Asia. So it's not like US tech and nothing. It's US tech and other things, and we're much more balanced right now in our portfolios compared to 6 months ago.
So Mark, Solita there mentioned one of the companies that you cover. Not sure which mic is working for me at this moment, but hopefully you all can hear me. Solita mentioned one of the companies that you cover, which is Amazon. And look, not all the internet companies are down. Meta is an exception, but a lot of the firms that you cover have fallen so far this year. Can I get your take on what you make of that sell-off and whether this is just a buying opportunity?
I think it's probably a healthy thing that we've had a bifurcation in stock price performance because we've had a bifurcation in some of these companies' fundamentals. Mag 7 there's some very different business models, very different markets in there. So if they were to all to trade the same, that'd be, I don't think that would be healthy. They're not trading the same. So maybe there's something in there that's good. The setup also, just so we remember, and Solita mentioned this too, we've been in a two and a half year bull market for tech. And it started when the interest rates spiked from 0 to 100, ended in the middle of 2022. Since that point, in the middle of 22, we've had a phenomenal surge in tech stocks. It's been a risk on market, and especially for the highest quality names, not for the lowest quality, for the highest quality names. So I've looked at names like that I look at, like Amazon and Google and Meta. And then there's a series of names under that, like Netflix and Spotify, that have done phenomenally well, and DoorDash and even Uber, that have done phenomenally well in that time period. That brought us to going into this year where multiples were pretty reasonable. I thought there was only really one dislocated name, high quality stock that was dislocated. I call them DHQs, and that was Uber. And it's performed great year to date. It's only 2 months, but it's up 20% year to date. We've had names like Spotify up almost 30% year to date, and Meta's up 12%. So I think the market's kind of discerned these companies reasonably well year to date. Google is underperformed. There's a lot of overhang issues on Google. There's regulatory issues, and then there's sort of relative underperformance, and I mean fundamental underperformance. The growth rate of advertising revenue at Meta is 2x that of Google. So one of the companies is doing great, the other company is doing good, and the stock should bifurcate, and they are. So I find a lot of this sort of healthy. And I know there's a huge amount of political uncertainty, and these companies also have dramatic international exposure, so that the global uncertainty just adds to these volatility in these names. But what I see so far in the market year to date, I think is reasonably rational.
Well, let's maybe get into that. And Solita, if you look at the market action, should I do all three mics? Maybe? There we go. Okay. Solita, if you look at the market reaction just yesterday, you get ISM comes in poor, you get announcements that tariffs will indeed be put on. It wasn't necessarily the international manufacturing stocks that did the worst. They, of course, sold off. It wasn't necessarily the importers that did the worst. It was tech stocks. That was the worst performing sector yesterday. What do you make of the macro of it all? The fact that we're having these macro, I guess you can call them mini shocks happening in the market, and that it's tech, it's AI, it's NVIDIA that seems to be faring the worst.
Yeah, look, I think we have seen the rotation in the market since the beginning of the year, right? And I think there's a continuation of that a little bit. But let's not forget, people are kind of selling things that have done the best, right? So taking profits and maybe reducing some of their position, not necessarily because they think things are worse in that industry, but sort of like reducing some of the risk in light of the fact that there might be some level of growth scare. The way I look at this rotation, sort of the American exceptionalism we have experienced in the US, right? The starting point has been different than the rest of the world, driven by technology. We had euphoria in the market around the election and post-election, number one. And since then, that euphoria is coming down because you have obviously a lot of policy, uncertainty, tariffs, export restrictions. You have some mixed data, not bad. I mean, let's put it this way. It's not like the market is down 10% year to date. So you have a different starting point. The rest of the world, the sentiment was so bearish. And since then, you're hearing more pro-business sentiment from China, maybe on the margin, better fiscal stimulus from Germany. You have potentially maybe earlier end of Ukraine, and then global manufacturing numbers have come in better. So, and when you see that rotation, naturally the tech stock gets hit the first. But I think this could last probably another 2-3 months. But I don't think that's a 2025 trade. It's maybe another quarter.
Mark, I'd love to get your thoughts on this as well, whether what we are seeing is just a rotation, to Solita's point that these were very loved stocks, or whether there is something to this new normal that we're in, where tech companies have gotten political, that at the inauguration, lined up behind President Trump was the CEOs of many of the companies that you cover. If they are more vulnerable when it comes to geopolitics in this new world where they have embraced Trump.
Okay, boy, there's a lot in there. I don't at all mind.
Take your time with it, Mark.
Yeah, I don't at all mind making political statements that just seem like smart business sense to be honest. Although I don't think we've ever seen an inauguration where we had the leading business leaders. Somebody can correct me on this, and maybe 100 years ago it happened. I don't recall it in my lifetime seeing that. So I thought that was pretty unusual, but maybe savvy on the part of these companies. And they know that this administration can be very volatile. He said all along he was going to be tariff man. Well, here we are. It shouldn't be that surprising. He's for good or for bad. He's true to his word, and I think these companies realize that. They thought it'd be better to get in his good graces rather than his bad graces. I'm not sure that's good for all of us, but it is the reality. And then, and I think about what would have we lived with in the past. Remember the sharp sell-off we had in tech in the fourth quarter of 2018. If you go back, I remember studying this once on Amazon. A stock to trade off 25%. I remember going back when I was writing a book on this, trying to remember why it corrected so much, and then I realized, oh yeah, China tariffs Trump. So the administrative decisions can occasionally, especially if you go big tariff, and maybe in regulation, you can have a real impact on these companies, not on their fundamentals. Amazon's fundamentals didn't change at all, but certainly on the multiple that the market's willing to pay, at least for a short period of time. We could well go through something like that now. The good news for investors in some of these names is that there's a heck of a lot of valuation support. Solita mentioned this earlier. I mean, you've got rock solid balance sheets, companies that are paying dividends, not Amazon, they should. But other names like Google and Meta, they're paying dividends now. They weren't back then. They're trading at 20, 22 times earnings, close to a market multiple. They're gushing free cash flow. So you're going to have less fundamental volatility. You can have maybe more stock volatility, and that should create, I mean, you trade off Amazon right now 25%, it'd be a screaming buy. Same thing with Meta and same thing with Google. Calling the bottom on these things is impossible. But these we've seen this before, and so that's the only guidance I'd give to people, which is, look, we came into the year with valuations reasonably normal. I considered them compound. These were we consider ourselves compound constructive. They hold the multiple. The stock goes up 20% because the earnings go up 20%. Hey, great. It's not that you're still looking for these dislocated names. My guess is that we're going to get more dislocation, unfortunately. But then, if you're a patient investor, these are the moments you wait for. So my guess is that we're going to get more dislocated. It's going to get more dislocated than less in the next month, and that's going to create good opportunities because I don't think the fundamentals have changed. Solita mentioned this earlier. There are companies here that are leaning heavily into AI, and I think they're getting a good ROAI, return on that artificial intelligence spend. And I'll talk about some examples later, but I can quickly click off. When Google tells you that 25% of their code is written by AI, that's an enormous cost savings. When Amazon is telling you that they now have a 25% lower cost to serve in their most advanced distribution centers because of robotics and automation, that's a really good sign. And then, I live in San Francisco and I see the ultimate AI machine roaming around, our city. There's 700 of these Waymos, and I think there's some wonderful innovations that are coming because of AI, and I think we're going to see more evidence of this ROAI. So at the margin, I'm more bullish on the fundamentals of the space, and if I'm just, we're waiting for these great dislocations. It never feels good, but I think they'll create opportunities.
Well, I think we only have about 5 minutes left, so I do want to end with basically where we started, which was DeepSeek. The fundamentals don't change based on the geopolitics. Solita, did DeepSeek, a cheaper model coming into the fore, presumably is more efficient. Does it change the fundamentals for U.S. tech at all?
I think it changes in a good way. Like I said in the beginning, I think doing things cheaper increases wider adoption, and that's part of our thesis. But I just want to make sure I say this right. Like, DeepSeek was a huge engineering feat, right? Because they created a more efficient model. But it's not necessarily a development feat. And those companies that want to keep on innovating, that want to break ground in the space, will still have to continue to spend, right? I mean, I think that's an important distinction. Yeah.
Yeah, Mark, I wonder your take. Are we going to look back at this moment and say, Microsoft and the hyperscalers, they all spent too much on CapEx and they should have known with DeepSeek and they should have pulled back? Do you think that that's a risk? Did DeepSeek change anything for the companies that you cover?
My guess is that if you're at the app layer, and Meta's the ultimate app layer stock, they're not selling LLMs, they're not selling cloud services. Anybody who comes across with more efficient, better, more productive, cheaper large language models. And then, it's open source, so you can look and see some of the hacks, and I mean that in a positive way, some of the tweaks that they made that allowed them to inference more cheaply, to develop these models, to develop the model more cheaply. I mean, that means that your cost of operations are potentially materially lower long term. That's a really great thing. I don't think these companies are going to cut back on their CapEx spend. It's well possible that they'll generate even more product, and names like Google and Meta and Amazon, more personalization, more targeting, more better targeted recommendations, better services for advertisers that advertise on those platforms, better campaign management, measurement. Like, I just think at that level, you've just anybody. It's an infrastructure improvement, and so the companies that buy the infrastructure benefit from that. So that was my take on DeepSeek, which is that this is a long-term benefit for some of these names.
Just to wrap things up here, I'd be remiss if I didn't do this. I just want to get both of yours top picks. I know, Solita, you're not going to give us individual names, so that's okay. You mentioned this a bit at the start, but what are your favorite sectors and regions now?
maybe I'll just, so US is our favorite region. Technology we like, financials and healthcare in the US. We like Germany. We like Chinese internet companies. But I would say on the AI, since that's our topic, our view is that it's really important to get exposure to AI across the entire value chain, both the enabling layer, application, and also intelligence. Now, over time, we think that the greatest value creation is going to come from application. In fact, we're already seeing, from a cost-saving story perspective, companies making headways. If you're a company that are spending a lot of money on administrative tasks, 15% productivity gain would make a huge difference. And we expect revenue and monetization to pick up this year as well. But we're still in the very early innings of that. So in the near term, we're tilting a lot more towards the enabling, so the infrastructure, chips, power, data storage, etc. So if I had $100 to invest in AI today, I would put 55 in enabling infrastructure, 30 in the application, and the rest in the intelligence layer.
Mark, where are you putting that pocket change of $100 in the companies you cover? What are your top picks?
I'll give two top picks, Uber and Amazon. I already mentioned Uber earlier. I think the bear argument on Uber is that there's only going to be one or two AV vendors, robotaxi vendors, and that they're not going to work with Uber. I don't think that's true. I may be wrong. And look, if all the world goes to Waymo, it's bad for Uber, and this stock call is going to be flat out wrong. But what we got today, if anybody lives in Austin, Texas, Waymo's available to you starting today on Uber's network, and I think we're going to see more of these type of partnerships. So as long as robotaxis are on Uber, there's a huge win, and it's a company that's generating 20% top-line growth, expanding margins, and trading at half of their free cash flow multiple. This is the only truly dislocated, high-quality name that I see right now. So Uber's our number one pick. Number two pick is Amazon. I think they're going to be a winner off of this, the dramatic increase in demand for cloud services because of the deployment of AI at all levels, but especially at the app level. 2 years ago, with the launch of OpenAI, there was a belief that Microsoft was going to be the winner in cloud services because they had the AI partnership. Well, that narrative is changing, and if it becomes clear a year or two from now that organically that the fastest growing AI cloud company is Amazon, that stock is going to go up materially from here. And then secondly, there's another theme tied into AI, which is robotics. And I've talked with investors who are looking for ways to play the boom in robotics. I have a great example of one, Amazon. They're probably the single largest deployer of robotics worldwide, and it comes through in the P&L. That's why their operating margins in their retail business now are moving up really aggressively. So Amazon's our number two pick, Uber's our number one pick.